Welcome and good afternoon to this particular webinar. Thank you for taking the time. This is another sort of webinar to which we, Gesternco, are inviting you to. This one is a subject-focused webinar. We're focusing on the current crisis and upheavals within the global banking sector, following the events of what happened over the past few weeks with Credit Suisse, Silicon Valley Bank, and obviously other banks. We're very happy. It is a different team which we have here. Usually we have the investment team with our webinars and myself, but here it is Tom Price and I. And just wanted to circle back and give you a bit of background on us. Obviously, most of you will know us, but we're an investment partnership with 1.1 billion of assets under management. We are building on the 60-year heritage of my family's investment business, and we manage assets on behalf of my family, but as well as institutions, families, individuals, charities, and trustees. So, as I said, this webinar is a bit different. Just introducing myself. So I'm the CEO and managing partner of Gesternco. But just by background, just wanted to let you know, I used to be an investment banker for 16 years, amongst of which advising financial institutions. For full transparency, I was at Lehman Brothers before and during the bankruptcy in 2008. And I have worked at Credit Suisse for some time. Tom, you want to introduce yourself?
Hi, thanks, Jerome. And my name's Tom Price. I'm also one of the partners at Stern, and I'm share responsibility with the investment team for risk. But my background, which is relevant to this, is really my core skill set is a lawyer, and in particular, a structuring lawyer. So I'm one of those people who sat in the back room of law firms coming up with weird and wonderful structures to enable things to happen, whether they were debt structures, equity structures, or fund structures.
So let's dive into that. Just want to give you a bit of background on our investment philosophy, which some of you will have heard, where we invest on behalf of our clients, following three main principles, which had been set by my grandfather and which we continue to follow, which is invest for the long term, do your own research, and invest only in quality. Here, it's the main thing for which is of interest here is do your own research. We invest only in companies which we understand, where we can assess their business, their environment, in order to be able to assess their quality. Our main equity strategy, for example, sees banks as not fulfilling our rigorous quality criteria, and we'll get back to that. But we, as a firm, always need to understand what we invest in. If we do not understand it or cannot understand it, we just don't invest. We take a very conservative view that some financial firms, banks, insurers, but also asset managers, are very complex, particularly global bulge bracket banks, for instance. They are so complex that they are very hard to understand, and the risk associated with those businesses is immense. So our research team is highly experienced and is truly world-class. So we could spend the time and work this through and understand them. But you know what? Life is too short, and we need to focus on what we see as quality. And hence, we exclude banks as being lower quality businesses and don't invest in them. So by background, and it might seem a bit odd for me to say that, we have been bankers as a family for more than 200 years. So it's quite odd for me to exclude banks as not being quality businesses. So we as a family have seen numerous banking crises. We've seen numerous banks come and go. We've seen crises such, for example, the Barings crisis, where from literally a day to the next, an entire bank just vanished because they took too much risk. We've seen the collapse of the Russian Empire. We've seen the Russian crisis in the late 1990s. We've seen as well over time banks being nationalized or being or even banks being rescued by the state. Banks usually have always been solid or always wanted to give the appearance of being solid. How do they do that? In older times, they invested in solid headquarters, very big buildings which looked solid. And today, it's not really the case as the markets have institutionalized, and people want to assess credit quality based on fundamentals. Today, but the business of banks has not changed. Banks is a great business where depositors deposit money on the promise that they can take it out anytime. But and then on the other side of the balance sheet, banks lend this money out to their clients on a longer time frame, and the margin they make for that is actually are their revenues at the simplest. Because this is a risky business, banks are regulated, heavily regulated, and the regulator imposes a strong part of capital which they have to put behind that business. And those are called core tier 1 ratios or tier 1 ratios, and are set at a bare minimum of 8%. And Credit Suisse, just to say, had no capital problem. It had a core tier 1 of 13%. That shows that capital is just not enough. So we all know that that equity markets were bad in 2022. They were not the worst, as you see on that slide. They were bad. A bad vintage. You see it. It's the MSCI World was down 17%. The S&P 18%. But what happened in 2023 is very peculiar. And it is those peculiar events that have led to the banking collapses and current crisis, which we're seeing today. So just quick historical recap. The global financial crisis of 2008 was solved by central banks reducing interest rates to virtually zero and injecting huge amounts of liquidity into the financial system. Then this went on for about 12 years, up to the COVID crisis, and COVID central banks said, well, it worked last time. Why don't we do the same thing again? So they put even more liquidity into that into the market. So what happened is that interest rates were firmly on zero, and then slowly but surely, the COVID crisis was resolved in late 2021, and then one started seeing supply chain constraints, which brought a bit of inflation up. And then in the first quarter of 2022, last year, the Ukraine war broke out, and hence oil went up hugely. And because of that, the inflation around the world started going out of control. At that point in time, central banks around the world took their bazookas and started raising interest rates very, very quickly. Never in the modern financial history have central banks increased interest rates that quickly from such low levels. And their first focus, you must always remember, central banks have two mandates. The first one is to get inflation within control. The second one is to keep to keep the financial sector stable, financial stability. So they were focused on the first one, getting inflation within their control, but raising interest rates had a lot of unintended consequences. Increased instability in the banking system is one of them. but I will come back to that later. Tom?
Yeah. So if we look then at a comparative year, well, we all know equity markets were bad, but do we know how bad on a comparative basis the debt markets were? So this chart basically takes the annual returns from the US Treasury T-bill, 10-year T-bill, for every single year since 1901. And you can see that 2022 was the worst year by a very, very long way. Yeah. And it's that is the fundamental cause of the first set of problems, because obviously with 10-year T-bill, which is the base measure for most debt markets, having dropped in price so much, there are a huge amount of losses sitting around that are being held, that are sitting there. Some will be on central banks, some will be in investors. And the question is, where in investors do they sit? Where do those losses sit? And the answer at first is in hold to maturity. So if we switch to the next slide. So hold to maturity in accounting terms, if you're a financial institution, whether you're a bank, an insurance company, or somebody else, and you don't necessarily have to mark to market all the assets you hold, particularly bonds or loans, if you intend to hold those to maturity. So this chart comes from the Federal Deposit Inc, the FDIC in the US, and it basically shows how much of the losses there are in 2022 on long-term government, long-term debt, and how much more of that debt, both proportionally and in total amount, is being held to maturity. So, and that is the change that has fundamentally caused a lot of the stress within the debt side of the financial markets, which is even bigger than the equity side. So if we turn first to the first bank, so Silicon Valley Bank was in a slightly special position. First of all, its client base is made up of tech companies and tech entrepreneurs. It had a very large amount of deposits above the guaranteed amount in the US of $250,000 per person. So if you hold, say, $500,000 at a US bank, and the bank goes bust, the US government will give you 250,000 of that $500,000. The other 250,000 is lost. So this is the amount that Ken Griffin said depositors should be wary of and should pay if they have money that's lost. Instead, in this case, that's the first thing, a large amount of deposits in excess. And that money is quite often from tech companies who've just raised a large sum of money, and they're sitting there waiting to spend it on salaries and third parties. So they were also looking for interest. And how had SVB managed to construct their interest? What they had done is they bought longer dated debt, which paid more interest, which meant that they could then pay more interest to the depositors and therefore keep the money. Now, remember, interest rates went up rather sharply in 2022. That means the balance sheet of the bank started to look less attractive, or more to the point, started to look like there was a lot more hold to maturity assets. And then, of course, it's the tech world. What happened? We had some social media going around saying the bank is unstable, and people started withdrawing money because if they had more than $250,000, they'd lose it. So they all started withdrawing money. The result was that you then have to start selling some of those hold to maturity investments because you don't have the cash disappears. Then the investments that are liquid start disappearing, and then the hold to maturity investments start disappearing. And that means you have to sell them at a loss. Yeah. So that was the reason why SVB started to disappear, and that was what caused the problem. Yeah. Now, is it going to happen again? Is this same problem going to happen again in the US? Yeah. The first point is, how has the US Federal Reserve come to step in? And what they've done is that they have said, if you've got hold to maturity investments that are being held to maturity, so in your books at par, and you need the cash, you can lend them, the bank will lend you at par value. So even if the T-bill is worth 84 cents on the dollar, the government and the Fed will lend you $1 for that T-bill. And that is how the Fed and the New York government have created stability out of the collapse of SVB, or hope to. The other point to note relating to this is that this is a US situation. Yeah. So in Europe, and for the systemic banks in the US, they have liquidity requirements which SVB was not subject to. So it is slightly different. Jerome, back to you to talk about Credit Suisse.
Fantastic. So the next shoe to drop, or the next domino to fall, was obviously the next weakest link. The weakest link was not in the US. The weakest link was Credit Suisse. I mean, if we go back in history, Credit Suisse has a litany of issues and scandals which it has been subject to over the past 20, 25 years. Even whilst I was working there, some of those unfolded. I think the issue at the end of the day is after a period of about 15 years of 0% interest rates, a lot of companies around the world have just become very lazy and have been operating as what we would call today in layman's terms zombie companies, and companies that would not exist were interest rates to go back to 5%. And that's exactly what happened. And Credit Suisse was very exposed to those companies. I mean, not only had it lost a lot of money operationally in its various scandals, and that was all this spiral was enough actually to force a crisis in confidence. Never forget that a bank is built on 4 pillars. First, capital, as I explained before. Second, the quality of the assets it invests in. That's a secondly. Third, liquidity. How liquid are those assets so that they can reach out if depositors want their money back straight away. And then lastly, confidence. And confidence started due to all those scandals, due to the pressures with vastly increasing interest rates, and on top of it, with all the scandals around, confidence in Credit Suisse started to wane. And what happened is that over the fourth quarter, about 121 billion of assets under management left the bank. That was seen as a big risk. SVB then went under, and then at the end of the day, Saudi National Bank, which was the bank's largest shareholder, then said publicly, in case Credit Suisse were to need some further capital, they would not put any more capital in. Well, that just led to a complete crisis in confidence, and over 1 week, about $38 billion of deposits, not assets under management, deposits, just went out of the door. And that put the bank on a very unstable footing, and that led to that fateful weekend. Before that, the Swiss National Bank tried to stabilize it, offering it a 50 billion lifeline. But guess what? Liquidity was not the issue here. It was confidence which was the issue. So how did that end up? Well, with a forced acquisition by UBS. I mean, that was, I want to say, expected to a certain extent. That's what many market commentators had said would happen. So that was to be expected. There was no public money which was used for that, besides the liquidity, but liquidity is going to come back. So there's no, there has not been a nationalization, which is very different from the approach how the banking crisis actually was resolved in 2008. However, there were two very unexpected provisions. The first one was that the merger or the rescue by UBS was done with excluding any shareholder approval on both banks. That is, if you look at Swiss shareholder or capital law, you will see that shareholder approval is a pillar of everything, especially in important circumstances such as this one. But the Swiss Federal Council promulgated an immediate ordinance over that fateful weekend to be able to exclude shareholder approvals only in the case of a rescue of a systematically important bank. Guess what? This Credit Suisse was such a bank. The other very unexpected provisions was the fact that the Swiss Federal Council and FINMA, which is the regulator of Swiss financial of the banks and Swiss asset managers, then said, you know what? We will the CoCo investors, CoCo bond investors, or AT1 investors, which is called additional tier 1 investors, will be written down to 0. So first, let's take it a step back. What is an additional tier 1 bond? Additional tier 1, and you see this on the chart which we have borrowed from the European European Commission. You see this. The additional tier 1 bonds are longer dated bonds which banks can issue in order to be able to be counted as capital, because they will be either written down or convertible to, or will be converted to equity in terms of a banking crisis. And we'll come back to which ones are, and that's exactly what happened. So what happened with this crisis of confidence, the Swiss government wanted to make sure that the crisis in confidence was stemmed once and for all. So they merged it with Credit Suisse. They offered it huge amounts of liquidity, and on top of it, they said, you know what? If there's someone which we need to sacrifice, we need to the additional tier 1 investors will be the sacrificial lamb, which will be so today, actually, to a certain extent, one needs to say that UBS made a good deal on this, but however, with core risk. To be fair, actually, UBS is probably in a better position to manage the risks which are within Credit Suisse than Credit Suisse itself. But that's one thing. Secondly, I am absolutely sure that that UBS is a far better place to be able to manage those risks out than the Swiss government itself. And that needs to be lauded, because it is not a nationalization and civil servants than managing a bank. It is another private entity which are now managing those risks. So go back to the additional tier 1s. Additional tier 1 bonds are very complex beasts. We have many friends across the financial markets which invest in those. We don't, by the way. We don't, because as we said, we don't. We think banks are not quality enough businesses, or are businesses not of enough high quality for us to invest in. However, some of those bonds might be interesting. However, AT1s are very complex beasts. This summary table shows how an excerpt which we got from Bloomberg of existing additional tier 1 bonds, and you see across for European banks, and you see across there that they're not all the same. Some have so-called temporary write-downs. Some have permanent write-downs, like the one in Credit Suisse, and by the way, UBS. Some have a forced equity conversion, which means at least as a additional tier 1 investor, you might get a share, a heavily diluted one, but you might get a share. Well, and some have total write-downs. And here, the core thing, and which is where litigation comes in, is that here it was set on the first page of the prospectus, the cover of the prospectus. It said that in the event of a bank failure or of a bank restructuring, those securities would be permanently written down. So, I mean, were the Swiss right? Well, we'll see. I think there's there's litigation going on. Some of our friends are doing that. I mean, some of our friendly investors have exposure to that. I mean, this is absolutely. I think there is. I absolutely understand the fact that litigation is there, but this is if you look at what the prospectus, it says permanent write-down very prominently on the front cover. So how do we, as a firm and as a family, actually look at bank risk and whether we should invest in that? First of all, shares of banks, you know what? Rather not. It's so complex. It is so, you need so much. So you need to put in so many hours and so much to take so many risk decisions around that we find this too opaque, and just as Warren Buffett puts it, we put it in the too difficult box. That doesn't work for us. Bonds of banks, well, potentially, but there we would veer again on the side of caution. We'd be very conservative and prefer to invest in senior or senior secured bonds. Cash on deposits, yeah, absolutely. We all have cash on deposits, absolutely, but make sure that that as an investor or as a private person or even as a business, that you hold not more than whatever amount is protected locally under the depositor protection schemes. And then lastly, securities held at banks within custody arrangements, we all use them. They are the rock which underpins everything in the financial markets. Yes, absolutely. I mean, if there's one good thing which came out of the Lehman Brothers bankruptcy, it is the fact that now every separately managed account is exactly that, a separately managed account, and is not commingled with the bank's balance sheet or with accounts of with the proper accounts of the bank or anything like that. That is, and hence, I mean, even if a bank fails, and a bank which has been custodian of the likelihood of getting your money back is actually very quickly there. I mean, I remember in my Lehman Brothers days, during the bankruptcy, we had exactly that issue, and before with a very significant corporate customer who had, I mean, significant amounts on within which back then Lehman held as in custody, and it took, I mean, because the bankruptcy process took a long time. It took about 2 years to get actually the start of their money back, and I think over 5 years they got 100% of their money back. So you get your money back, but just everything is stuck for a very long time, and that is something which you need to be worried about. Tom?
Yeah. So then we start looking at where bank risk rise within what you're invested in. Yeah. And the first one is mutual funds and physical ETFs, where the risks are similar. And in essence, the risks are cash on deposit, i.e. what the mutual fund or the ETF has rather than what you have, and where they've lent out securities. So
yeah, but why are banks involved here?
Well, banks are involved because a mutual fund has subscriptions and redemptions going on. And every time the subscription or redemption occurs, there's some cash involved. So that cash has to fit somewhere. You can have, in our structures, we use a bank that doesn't do very much, RBC Investor Services Bank, which takes away some of that risk because it's not really a normal bank in the sense of Credit Suisse. It's definitely not a Credit Suisse type bank. And on the security lending side, that is also an area where if you lend securities out, if a mutual fund lends securities out or an ETF lends securities out, then the question is, can they call their securities back if the person who's borrowed it? So that is the first place that you should look to. That's where the risk lies. The quantity of that risk depends on who the counterparty is. What can you do as an external investor? The real answer is not a huge amount other than ask questions. Make sure you've asked the questions. And then once you've asked the questions, take a decision then as to what's going on. Yeah. The second area is structured products. Structured products, for those who don't know us, we're not huge fans of structured products overall. But quite often you find what the structured product actually ends up being is a bond, and it's a bond issued by the bank whose return depends on other things. So if it is a bond issued by the bank, check what form it is, then of course that bank is ultimately where your first risk lies. That's where your credit risk lies. Yeah. The third area is synthetic ETFs. And synthetic ETFs they're very, very different to physical ETFs. Why? Because behind the ETF, there are no assets. Behind there is a derivative or some other instrument that is issued by a bank. It may be a bond. Indeed, some ETFs will actually be bonds rather than actually a share in something. So those synthetic ETFs, when bank credit risk becomes live, are things that you need to look at quite closely. Yeah. The last one is commodity and more exotic ETFs and fund products. These are very, very complex. Many years ago, I set up one of the larger ones of these complex commodity ETFs, and the underlying pool of assets is derivatives, and the derivatives are issued by a bank. So if the bank cannot perform, then the assets can't be sold. You can't generate any cash. Therefore, you cannot get out of the ETF, which means that which means a discount will open up in the stock market between the ETF and the underlying assets. So that will then steer you away from your benchmark, which means it's something you want to avoid. So those sort of areas, that's where the credit risk will live. And the question is, how do you look at it? How do you look at it from an outside investor? You have two choices. Yeah, the first choice, which is to unpick the terms, read the prospectus, try and work out where the risk factors are, work out who the counterparties are, and see who those counterparties are. The real unknitting, they may not give you access to, you may not have access to, but as you go into it, you then have the ability to make a decision as to whether to keep that investment or not. Back to you, Jerome.
Are we back in the 2008 spiral? No, definitely not yet. Has confidence in our global banking system ebbed out? No, it has been reduced. I think the authorities to date on both sides of the Atlantic have done it the right way to be able to save those institutions and make sure that the crisis doesn't escalate and that into a contagion. I think this is absolutely right. But let's not forget that actually the reason why we're there is an unintended consequence of actually central banks trying to solve another problem, which is the problem of inflation. So, and then the fact was that actually due to this 15-year stint of low to very low interest rates has led a lot of management to become lazy, and also banks to become to say, well, I don't need, it works also if I continue to take more risk. And that's exactly what Credit Suisse did, for example. They never got their risk management under control across their business. Even when I was there, it was the case. And that is something which is and when you put that, then you look yourself back into the end of the first quarter 2022, Ukraine war, inflation going really escalating hugely, central banks saying now we need to be tough, and we need to be true to our first mandate to get inflation back under control. And what happened? Interest rates were raised, but to a point and with a speed which was unheard of and never seen. And that is exactly the reason why we're there. It's there. Will it continue? I think yes. I mean, the weaker links within the financial system will always be prone to crisis in confidence. Always. Should they fail? I mean, I would say probably they should. I mean, survival of the fittest to a certain extent it makes the remaining system actually better. So actually they should. And those artificially low interest rates have saved actually those, poor quality business actually, but that's not the case. It shouldn't happen. So businesses should be able to withstand, quality businesses always withstand, and businesses in general should be able to withstand 5% interest rates. And I think if you manage your risk properly as a treasurer, as a CFO, then it should be okay. And banks, it's the same thing. Banks should be able to have proper risk management in place in order to manage their own business. If they don't, and they're too focused on one thing, like Credit Suisse was, or like SVB was, for example, or like Signature Bank, which is another one that failed, that's fine. Well, just by the way, over the weekend, the remaining carcass of SVB got bought by another institution. That is how survival of the fittest then continues to happen. I mean, it obviously, when a bank run happens, it makes no sense to start one. Like, for example, the chairman of the Saudi National Bank, which really, I mean, opened the floodgates to this crisis in confidence to Credit Suisse. But when one is if you're exposed to a bank and you see confidence ebbing, does it make sense to reduce risk and to take deposits away or to take your exposure down to that financial institution? Yes, absolutely. Does it make sense to do this fast? Absolutely. Straight away, up to the deposit limit, because that is the same thing. And quality businesses, institutionally held businesses have multiple banks, multiple accounts, diversified sources of funding, etc., etc. And that is exactly what many businesses in Silicon Valley did not have. They focused very much on their great relationship with SVB, not knowing that actually SVB had such a poor record in investing actually their depositors' money. So that is really that's really a conclusion. I mean, we believe here that the authorities are taking the right steps in order to be able to maximize financial stability within that higher interest rates environment. Will other banks fail? Maybe. Will it be systematic? We don't believe so at this stage. I mean, but on a word of positiveness, I mean, I was there at Lehman when it happened. I'm still here. So I think we have some of our team members here as well. I think the core thing is really to be able to diversify your risk manage, and then look forward and continue to invest in quality businesses.